Hello viewers, my name is Ayabonga Stofile from Nyanga High School at Krisani East District. Welcome to the Eastern Cape Department of Education Broadcast Studio. Today, the lesson is about the circular flow, the national account aggregates. I'll be covering this topic for your full understanding. Let's get to it. The first thing that we need to discuss is the circular flow normally measures the level of economic activity in the country, which means it measures the money flows, the real flows in an economy. So there's a need to put more emphasis on the calculation of such measures using the national account aggregates. So as we said, the national account aggregates focuses on the entire South African economy. So which means it's macroeconomics. So it allows the government, the stakeholders to make informed decisions towards the policies of a country. Now, this particular question, this particular topic is assessed in multiple choice questions. That is section A. It is also assessed in matching columns. You can also find it in one-word terms. Also, in section B, you also get these kind of questions whereby you are required to list, whereby you are required to explain how does one variable links to the next variable. So I highly recommend that you get familiar with all these concepts of this particular topic. Also, you find this particular topic under the data responses at section B, so whereby you are going to be asked 10-mark questions. So they start from 1 mark, 1 mark, and then 2 marks, 2 marks, and then the last one will be more like a middle order, which consists of 4 marks. Also, there will be middle order questions for 8-mark questions, and also the questions that provoke the thinking process of a learner, whereby you get the high order question based on this particular question. Now, the national account aggregates are very, very important to an economy because they bring about a glimpse on how our economy is performing. So they measure the performance of an economy. Also, the circular flow, people refer to it as a circular flow of income, the circular flow of expenditure, but they tend to neglect the fact that the expenditure and income starts by production. So in order for people to earn income, there has to be a production. In order for people to make an expenditure, there has to be a production because of the utility of form that is required to the individuals. In our societies, our wants provoke the production because we need the products that are going to satisfy our endless wants. They need to be at the correct shape and form to satisfy these particular needs and wants. So the first method of calculating the gross domestic product is called the production method. So the production method is also called the GDP-P. So this one considers all the expenditures that is made by the people that are producing goods and services in the economy, ranging from the businesses, other enterprises, the government, including the foreign sector of our economy, all those that participate in production of goods and services. So their framework is derived at a level of the microeconomic policies. So which means we study the behavior of certain elements of the production in the economy. Then the next part, we need to understand that the production may take a wide range, ranging from the primary sector, extraction of resources from the nature, secondary sector, tertiary sectors of our economy. Whether the focus is on agriculture, whether the focus is on mining, it's on manufacturing, construction, and service production. So these are the components that we have under the production method. If we are about to calculate the production method, the mistake that we can make is to add all the market values of all the outputs that are produced in the country. Because if we add the market values, it would mean that the total will actually be greater than what it's supposed to be. Such calculations may lead to items like double counting or multiple counting, whereby a figure is going to reflect more than twice. Then we are able to rectify the double counting. We do that by subtracting the intermediate inputs from the final outputs, so that we find the value that was added by each stage in the production process. So if, for example, you purchased a resource for 10,000 and then the market value of that resource ends up being 22,000, then we know that you added the value of 12,000. So it focuses on the value only that has been added by this stage of the production process. So if you are using this method, it will yield the GDP at basic prices, because the first price, the first answer that you are going to get is based on the basic prices. Looking at this one, this is how the production method should look like. So if we pay attention on this method, then we will see that we are having the primary, the secondary, and the tertiary sector of our economy. Now, if we add these sectors of our economy, we're going to get the gross value added at basic prices. So it means now there is no value of secondary of primary sector at secondary sector. There is no value of secondary sector at tertiary sector. So each and every sector is independent. What is reflected here is just the value that is added by each sector in the production process. So we get, if we add line 1, line 2, and the third line, we get the gross value added at basic price. So these are the actual prices of goods and services before the state may interfere with taxes and subsidies in the economy. Then the next step, when you're doing production method, you need to locate and look for the taxes that will be charged on the products. So it means now the products are already made here, then there are taxes that are associated with those particular products, ranging from the value added tax, the sin tax, you name them, all the taxes that are imposed on the consumption of goods and services. Then also we deduct the subsidies on products. So the main reason why we add taxes is because the taxes are going to increase the price of a product, and the main reason why we deduct subsidies is because they are able to lower the price of a good to make it cheaper and affordable to the consumers. Now, from the basic price, if you add the taxes on products and deduct the subsidies on products, you get the gross domestic product at market price. So this market price is the price at which these particular goods will be sold at, will be offered in the particular market. So it's very, very important to understand those particular components. The second method of calculating the national account aggregates, or the GDP, is called an income method. Under this particular method, we're going to add all the levels of income that are earned by the owners of the factors of production in an economy. So we say the owners are normally the households, because they own directly or indirectly the 4 factors of production. When you are using this income method, it will yield the GDP at factor cost, because the first response that you get is the factor cost, the cost of production. So it symbolizes how much money is earned by our factors of production within the borders of a country. So this method is also called the GDPI, because it yields an income. Then at a later stage, we are going to convert within this particular method from GDP, that is gross domestic product, we convert to the gross national income. So at a later stage also, we are going to use this particular method to convert from gross national income and convert to the gross national disposable income. We're going to explain them at a later stage. So let's look at the income method. If we talk about the income method, it will be similar to this one. So the first line, we are having the compensation of employees. So the compensation of employees is the first line that we are having. So if we talk about the compensation of employees, it includes all the salaries and wages before the deductions have been made. And then we talk about the taxes that are used as deductions for wages and salaries. Then at the second line, we have the net operating surplus. Net operating surplus consists of all the profits that are made by the businesses. It's revenue minus the costs that are made by, incurred by a business. So it talks to the factor of production that is the entrepreneurship. Then the next one, we have the consumption of fixed capital. The consumption of fixed capital consists of all the elements that are associated with the capital usage in the economy, ranging from interest, ranging from the depreciation, the wear and tear of capital goods in the production process. Now, if you pay close attention, the first line, the second line, and the third line, these symbolizes the income earned by the factors of production in an economy. Now, if we add them, they give us the gross value added factor cost. This is how much our factors of production are worth within the borders of a country. Now, from this, we move to the next line by adding other taxes on production. There may be taxes that may be imposed in the production process of goods and services. For example, the environmental taxes may be imposed on the production process. Then if those are imposed, then they are going to increase the price of goods and services. Also, we talk about the deduction of other subsidies on production. Maybe we can get the subsidies from the state. The state may subsidize if we're operating at an environmentally friendly way that does not hamper the environment at all. Then the next part talks about the gross value added at basic prices. Remember, under the production method, we also talked about the basic prices, and we said it's the price, is the actual price that is paid before the taxes and subsidies on products. One needs to take into consideration the main differences between the taxes. The first one talks about the taxes on production. The next one talks about the taxes on products. So which means they are not imposed on the production process of goods and services. Rather, they are imposed on the directly on the products to increase their prices. That is why we are going to add those. Then also we have the subsidies on products that we are deducting, whereby the government will want the products to become cheaper by imposing a subsidy, ensuring that these products are cheaper. Then we add the taxes on the basic price on products, and then we deduct the subsidies on products. Then we get the gross domestic product at market prices. So this is the actual income method. It's supposed to end there because it's the market price. This is the actual income. However, we discover that there are South Africans that are not only residing within the borders of a country, but also they are residing in all other countries across the world. So we need to take their income into consideration. So how do we do that? We add the income that they earn because they are part of the factors of production that are from South Africa. So we call their income as the primary income from the rest of the world. Then there are also the individuals that are working in South Africa who are not the permanent residents of South Africa. Then we call those the level of income that they earn. It's the primary income to the rest of the world. So we deduct it because they are not South Africans. So if we take the GDP at market prices, we add the primary income from the rest of the world, and then we add the primary income to we deduct the primary income to the rest of the world. Then we get the gross national income at market prices. So this is an actual amount that is spent by the South Africans. But most importantly, South Africa has a different history than other countries because there is a group of population that does not have an income. So they are provided this particular income through donations. They are provided this kind of income through social security payments. Then we call those current transfers. So the next line talks about the current transfers from the rest of the world. This includes the grants that are earned by the South Africans in whatever country that they are. So we take them and add back to their national income because they are South Africans anyway. Then we also deduct the current transfers to the rest of the world. The grants, the donations that are made to a non-permanent resident of South Africa. Then we deduct them. Then if we add from the market price, we from the gross national income, we add the current transfers from the rest of the world, we deduct the current transfers to the rest of the world, then we get the gross national disposable income at market prices. This is the actual amount that is available to be spent by the South African households, whether they are working or they are not working, as long as they are able to earn an income in the economy. And now moving along, we have the last method of calculating the gross domestic product. This method is called an expenditure method. So under the expenditure method, we are going to measure the total expenditure of final goods and services produced within the national territories. So they are produced in South Africa. We measure that particular expenditure. So we're going to add all the expenditure that is made by different participants in an economy. So ranging from households, the firms, the government, including the foreign sector, all the four main participants in our circular flow. Also, this should determine us the level of exports in the country and also the level of imports in the country to actually understand, are we exporting more or are we importing more goods and services to the rest of the world. Let's look at the schedule of the expenditure method. Under the expenditure method, you'll discover that on the first line, we do have the compensation, the final consumption expenditure by households. On the second line, the final consumption expenditure by general government. Then the third one talks about the gross capital formation. So if we talk about this, the first one refers to households, the amount of money that is spent by our households. Some may ask the question, why do we have more money when we talk about the expenditure of households? It's because the households are regarded in our economy as the primary consumers. So their role is just to purchase the goods and services. Then the second line has to do with the government, the amount that is spent by government on final goods and services. Then the third one talks more about the gross capital formation. When businesses want to expand, when businesses want to invest in capital goods, that particular expenditure will be reflected under the gross capital formation. Then if we add these three, they are supposed to give us the gross domestic expenditure. But now if we look at this, there is no total that is 2982 because there is a shortage of 24. So which means this shortage is an amount that has been undercasted. So which means when we are preparing the national account aggregates in 2011, there were mistakes that were made. So the amount of 24 is to account for those particular mistakes. So if the mistake was made on the final consumption expenditure by general government, we're not going to go and rectify that amount. It will be reflected under the residual item. So a residual item, basically, it's a balancing figure. If it's positive just like this, it means we undercasted. However, the residual item can become negative. If it becomes negative, it means we overstated the figure. Now, after we get the gross domestic expenditure, then we need to note that our expenditure is also divided because we are able to produce and sell to the rest of the world. So it means the expenditure on our goods that are produced locally and sold to the rest of the world should be added to the gross domestic expenditure. Then we call those the exports. Then also we minus the imports of goods and services. So the main reason why we minus imports is because it's the expenditure that has been made by the residents of a country, but they made this expenditure outside the borders of a country. So these goods are not locally produced. That is why we deduct this particular expenditure. Now we get the final response, which is expenditure on GDP at market prices. Also, if you note that the expenditure method at market prices is equal to the production method at market prices and also equal to the income method at market prices, because the expenditure, income, and production is the same under the national account aggregates. Now, you may come across different activities ranging from multiple choice, data responses, and high and middle order questions. So for this particular activity, you are given a data response. This is just an example of an activity under the national account aggregates. So you are required here to identify the factor of production. So if we say the factor of production at 2.3.1 in the table above, that receives the biggest portion of the national income. So you need to pay attention to the requirements of the question. The question did not require the participant. The question required the factor of production. So you need to look at this particular table and then be able to determine which one is a factor of production that is required. The second question is which method was used to calculate the GDP figures above. So we talk about the figures, the GDP figures, and then we have three methods of calculating. So which one is it? Based from my presentation, which one would you say is the method that is used here? Then the next question, briefly describe the term basic prices. So we talked about the basic prices and we explained what does the term basic prices mean. Then the next one, briefly explain how subsidies can influence production. So in this case, you are required to give more of a response towards a relation between subsidies and the production. Don't just explain the subsidies, but make it a point that you're able to meet the requirements of the question. Explain how subsidies can influence the production, whether they are going to increase the production process, whether they are going to decrease the production process, and explain. The last question requires one to calculate. So if you are faced with these questions whereby you are required to calculate the gross domestic product at market prices, that is the value of A, I normally advise you guys to extract the table, extract whatever information that you will need in this particular table to give you the final response. Make sure that the taxes are added, make sure that the subsidies are subtracted. This brings us to the end of today's lesson. But before we end the lesson, we need also to understand there is also the conversion from nominal GDP to the real GDP. So if we talk about the nominal GDP, we talk about the GDP that is expressed according to the relevant time period, the prices of today. So which means the prices of today are expensive, then it means that is a nominal GDP. On the other hand, we also talk about the real GDP, the GDP where the effects of inflation have been considered on the nominal GDP by deflating the index. So which means we deflate the index. We talk about the prices that are relevant to the constant prices. So the next concept talks about the GDP deflator. So the GDP deflator enables us to be able to measure the prices since a specific base year, whether the prices increased or the prices decreased. Then the next one, there is a formula for us to calculate the GDP deflator. You just take your nominal GDP, you divide by the real GDP, you multiply by 100, then you get your GDP deflator. The next formula symbolizes the calculation of the real GDP, whereby you will be required to have the nominal GDP, you multiply it by 100, divide by the GDP deflator. Having the real GDP for 2 years is very, very important because it allows us to compare the economic production of a country. If the economic production is increasing or decreasing, it requires us to have these particular concepts. Now here we are having a worked example. So this is an example, this is a scenario whereby we are trying to show the differences between the nominal and the real GDP of a country. Now we are also going to calculate the real GDP, we are also going to calculate the GDP deflator as well. Under this activity, we are just assuming that we are producing only the desk in our economy for the year 2008 as a base year. So it's the year at which we are going to compare the prices to. That is the base year. Now, if you pay attention also, we have the year, we have the quantities, we have the price, we have also the value, that is the nominal value or the nominal GDP. Now, upper, we are trying by all means to ensure that we are able to pinpoint the differences between the real and the nominal GDP. So let's move. If we're about to calculate the real GDP, let's say for 2015, the first step that we need is to be able to calculate the inflation. So the prices in 2015 were 535. Then we deduct the prices of a base year, which is 2008, 390. Then we get 145. So that 145 symbolizes that the prices increased by 145 in our example. Now, the second step would be to deflate the index. So you take the current price, that is 535, you minus the inflation, which is 145, and then you get 390. That 390 becomes a constant price, the price that we are going to use for calculating the real GDP. Then we use that particular 390 multiplied by the quantities that were produced in 2015, which is 2000 as well. So we are getting the 780,000. So this 780,000 is actually lesser than 1,070,000. Why is it lesser? It's because we deflated the index here. So if you pay attention, this amount of money equals to the amount of money of 2008 because the quantities did not increase. So this is why we need to do more of the real GDP to actually tell us whether we produced more goods and services or we produced lesser goods and services. So you are going to have this the same schedule, but the question is, can you be able to calculate the GDP deflator for 2015? The deflator. So the formula is already here. So you need to calculate, to substitute to be able to calculate the deflator for 2015. Then the second question will be, use the GDP deflator of 230.7692308 to calculate the real GDP for 2025. Show all workings. So you must be able to do this. After 2 minutes or 2 to 3 minutes or 4 minutes maximum, you should be able to calculate. Then I'll just come and reflect on the activity. All right, welcome back. So this is a proposed solution. So the first step, you needed to calculate the inflation. So the inflation for 2015 amounts to 145. The second step is to deflate the index. So if you deflate the index, you get 390. Then from that, you need also to calculate the real GDP. The real GDP for 2015 is 780,000. Now you use that information to calculate the GDP deflator. You copy the formula, you substitute on the formula, and then you get your GDP deflator. This is the actual GDP deflator. For the second part, you copy the formula for real GDP, and then you substitute with the GDP deflator that was given on that particular question, and then you get your real GDP. So this is the national account aggregates. So we started explaining the meaning of the national account aggregates, the system of the national account aggregates, why do we derive the national account aggregates, and also unpacked the production methods of calculating the GDP, and also explained the income method. We converted from the income method to GNI, we converted to the national disposable income as well. Then we also did the expenditure method, and then lastly we converted from GDP to the real GDP, from nominal GDP to the real GDP, and also we talked about the GDP deflator. We have come to an end of our lesson. You can leave your questions on the comments below. Don't forget to leave the name of your school so we give shout outs. Please share, recommend, and subscribe to our YouTube channel. Thank you for watching. See you on our next lesson.